extent that you don't necessarily see sometimes fundamental reasons why some of these patterns do repeat themselves, to what extent do you think that there is a component of self-fulfilling prophecy to some of these things, like the behavior of investors once they see a certain price dynamic will then lead them to act in a certain way? How do you think about that continuum between fundamental dynamics at play versus sort of behavioral slash expectation reasons?
That's a good question. There might be some aspects of self-fulfilling prophecies. Most of the indicators, I don't think are self-fulfilling prophecies, because even again in my first book, I talked about the fact that I called the negative predictive power of interest rate futures. What I meant by that is the more interest rates are projected higher in the future, the lower they're actually likely to be, and converse. So when we in 2020, the rates were like 0, 0, 0 forever, that was a little bit in hindsight an excellent predictor that actually hiking will start much earlier than people realize. And right now, hike is an excellent predictor that rates will be 0 in 2023, which is my central view currently, by the way.
So is it just that the market now is conditioned to do the work of central bankers in advance of the central bankers actually needing to raise rates and or run off their balance sheets? Like what is the underlying dynamic there that causes this, changes in rates to be such an inverse indicator of what to expect going forward?
I think a lot of this has to do with their kind of human conditioning, which is even for smartest humans and very hard to avoid. And even I'm often subject to that conditioning, even though I'm talk about this and I'm very aware of this. Is the conditioning that people very much have the feel that the environment that is currently now will persist further. It's a very fundamental, strong feeling. Like when, for example, if there is like a COVID wave, we're like, okay, let's hunker down. This is where the COVID is worst. While, for example, with the height of COVID wave, that's already where it's going to come off, right? And it's been like a lot of those things going during pandemic. The example I gave actually in my second book was if you walk on the beach and there's a narrow strip of land and you see the waves coming in and out, and you want to run through this without getting wet. Now, if you're going to wait for the wave to start receding, you're going to start running. The wave will come in as you're running and get you wet. What you should do, you should start running when the wave is still at the high, knowing that it's going to start receding as you're running, and you'll run in the gap of time when it starts receding. So it's very hard to think about this way in the markets. So what happens is, and people like saying things like inflation is high, labor market is tight, high. Usually it's at the time when those things of the past. That is currently my, again, possibly flawed, but biased, well, if you wish, my bias towards the situation. I think this whole inflationary scare is a thing of the past. That's something that did happen. And worrying about, and to me, like, I feel like I'm in some kind of weird, insane world that people are talking about worrying about inflation right now. I think the worries should be very different right now, but they are worried about inflation and they are pushing up their interest rates. And I think that as it always happened before, it will happen the other way.
Isn't it the very fact that you have to have the overreaction in order to get back to zero? You have to have the inflationary impulse. You have to have this supposed reaction and potential error in policy to then have to unwind it all the way back down to a zero rate once it's realized that the inflation may have been transitory in some sense, right? You've mistimed the you're running across the wave a little bit.
Yes, and I think the Fed I think the economy is gonna get splashed, and very well, not necessarily, but I think the odds are heightened of us all getting splashed by this. Yes. What is interesting about this environment that I don't even know if they're gonna get rates very high, because I don't think usually things look like they do now at the beginning of a hiking cycle. Like inverted yield curves usually would come much later. again, I'm not really a huge expert on studying this, but things are beginning to look like, usually at the beginning of the hiking cycle, financial conditions seem to pretty loose. Dollar was, for example, in 2004, we started hiking cycle, dollar continued to weaken from 2004 to 2007. Gold had an enormous rally. Nothing like, we're talking about gold rallying last few weeks. That's like nothing. It's just but noise, up $20, down $20. Gold went from $300 to eventual high of like $1,800, right? The following decade. There was nothing like that going on right now, right? Silver went like almost up to $50, and that is back then, right? So we're not seeing any of these dynamics. We're not seeing any of the dynamics. And there was none of like 2004, 2005. Interestingly, market was very cautious about pricing hikes. They weren't pricing a lot of hikes. They ended up hiking more than the market price. Right now, market started to get really aggressive about pricing hikes. It's a very deep, and those is usually like when market, because first market usually resists, no, and then they're gonna hike, maybe like once or twice, and then like, oh, okay, we're gonna hike. 2006, 2007, that's when eventually like, okay, bond market sells off and gives up, right? And that's what happens afterwards, Great Recession, right?